General, journal, and then adjustments. So for the following transaction, show the entries in the GJ, and we are doing this for the year ended 31 March 2025. So this is the last day of your current financial year. This means that your financial year started on the 1st of April 2024, ending then on 30 March 2025. Transaction number 1 reads as follows. The insurance for March 2025 has not yet been paid. So if it's an expense that you should have paid for the current financial year and you haven't yet done so, it means that you have an accrued expense. And accrued expenses are liabilities. You now need to remember that if you haven't yet paid an expense, it means that you haven't yet recorded the expense. And remember, once again, GARP principle, the matching principle, states that I must incur all the expenses that I must record all the expenses that I incurred for the current financial year. I must record those transactions in my current financial year, which means that I now need to go and include the insurance for March that I haven't yet recorded. So I'm going to say that I'm going to debit my insurance expense account, and I'm going to say that that is 800 Rand. There's no debtors, no creditors affected here. Therefore, I will not add any amounts there. If you really want to, you can just draw a line or you can add a 0. Right. Then I haven't yet made payment. Therefore, I'm crediting my accrued expenses with 800 Rand. And that is it. Okay, so now I've included the expense and I've shown that I have a new current liability that is accrued expenses. Right, moving on to 4.1.2. So the rent income for April was received on the 31st of March 2025. So April is after my current financial year end, and I have already received the rent for April, which means that I've already recorded the rent for April in March, but that is not allowed because once again, the matching principle. So I need to now remove this rent income from my March records, and I have to reclassify that as a current liability, income received in advance. Because come April, I either have to give them the space that they have paid for, or I must give their money back. And it then says that the rent increased by 5% on the 1st of Jan 2025. So in other words, by 31 March, this increase had already taken effect. And it says that prior to this, the rent was 10,000 Rand per month. Just give me a moment real quick, please. Right. So the rent income that I received in March for April was the increased amount, so increased by 5%. Prior to this increase, the rent was 10,000 Rand per month, which means that I now need to go and calculate what was my rent after the increase. So 10% prior, 10,000 Rand prior to the increase, add to that my 5%, and that was 10,000 times 105 divided by 100, so 10,500. So I now need to remove it from my rent income account. So to remove it from an income account means that I have to debit the income account by 10,500. No debtors, no creditors, so I won't show anything there. And now this is income received in advance. 10,500 increase in the liability. Next up, depreciation, our lovely old friend. So for vehicles, it is at 10% using the straight line method. So straight line method meaning that it is on cost. So I like to then just include somewhere that I don't have to continue going back to the question paper, 10% at cost. And then for my equipment, it's 20% at carrying value, because diminishing balance means on the carrying value being cost minus accumulated depreciation on the first day of the current financial year. Then it says that the extract of the records on the 1st of April 2024, so in other words, the first day of my current financial year, I had equipment with a cost of 100,000 I had vehicles at a cost of 700,000. And then I had accumulated depreciation on my equipment of 80,000. And I had accumulated depreciation on my vehicles of 450,000. Okay, so that's where it stands at currently. But if I then continue, a vehicle with a cost price of 400,000 Rand was purchased on the 1st of September. So I didn't only have the 700,000 Rand vehicles for the year, I also purchased a new one. So that's why it's important to split your calculations between your old and your new assets. And the new one was purchased at 400,000 Rand, but only on the 1st of September 2024. That's extremely important because remember, your depreciation rates, those are per annum. And if you didn't own the asset for the full financial year, you can't calculate the depreciation on that asset for the full year because then you will be overstating your expenses and you're not allowed to do that. Okay, so starting with my equipment, it is on carrying value. Carrying value is cost minus accumulated depreciation at 20% per annum, and I had this for the full financial year. So 20,000 times 20%, and I had for the full financial year, therefore 4,000 Rand for my equipment. Then for my vehicles, it is at cost, so 700,000, just want another space there, 700,000 times 10%, and I had that for the full financial year as well. You know that I always write the 12 over 12, just so that I don't forget to do it at a later stage if I didn't own this asset for the full financial year. So that's 70,000. Just remember that you must always double check that when you now record this new depreciation movement for the current year, that your accumulated depreciation doesn't exceed your cost. Because remember, you may only write off an asset until it reaches a carrying value of 1 Rand. But we are still safe here because it's only 520 now, and our cost is 700,000. Okay, next up, the new one, 400,000 Rand times 10%. And I only had it for, and I hope it won't result in decimals, I only had it for December. No, not December. It was September. Yes. So September, October, November, December, Jan, Feb, March, because my financial year ended on 31 March. So remember, I've told you in class as well, it's fine to count on your fingers. We all do it. So September, October, November, December, Jan, Feb, March. So for 7 out of the 12 months that we had this, and we are counting September because we purchased it on the 1st of September. Had we purchased this on the 30th of September, we wouldn't have counted September as well. So we purchased this for 400,000 and then 10% depreciation per annum, but only for 7 out of the 12 months. It's fine. You won't get decimals in the paper. We usually ensure that you don't get decimals even at NSC level, but I'm just going to round it off for now. So if you do make a mistake and you do get decimals, just round it off because we don't always have time to go back to try and figure out where we went wrong. Okay, right. So therefore, for your vehicles, your total depreciation expense for this year is your 70,000 on the old vehicles plus the 23,330 on the new vehicles. So total that you have there. Okay, so let's go to our journal entries. So we need to debit depreciation. We need to debit it because we had accumulated depreciation on equipment, so you have to be specific. And the accumulated depreciation on equipment is increasing by 4,000 Rand. So 4,000, remember, accumulated depreciation is a negative asset account, therefore it increases on the debit side. And then you also had accumulated depreciation on vehicles, and that was 93,330. So in total, your depreciation account is increasing by 97,330 Rand. No debtors here, no creditors, so we're not going to do anything in those columns there. Then the last one says that the annual Wi-Fi is payable on the 1st of December. So as soon as you see an annual payment that is made on a specific date, you need to look out for a prepaid expense, because now we're looking at the 1st of December. Our financial year end is 31 March. So we have paid for December, Jan, Feb, March. Whatever we paid for after March is a prepaid expense. So that is an asset that may not be included in my expenses. So I need to remove it from my expenses and reclassify that as a current asset. It says here that the annual premium was 6,000 Rand until 30 November 2024. In other words, for April, May, June, July, August, September, October, November. For 8 months in your current financial year, it was 6,000. So times by 8/12 to see how much you should have had there. This is now for calculating the expense, okay? We're not going to record the expense now. It's just if you had to do this, the trial balance, then you would have now done that to calculate what's to be included. Then it says that after this, an 8% increase came into effect. So in other words, we no longer had the 6,000 Rand. We had that at an increase of 8%. So we'll calculate that. So 6,000 times 108 divided by 100, and that is 6,480 Rand. Okay, so that is now my annual premium that I had for the remaining 12 months of my financial year. They are saying that this annual premium was paid on the due date. In other words, on the 1st of December, I made this payment over here, but I made the payment for the full financial year, so for 12 months. And we said that from the 1st of December, it's only December, Jan, Feb, March, only the 4 months within our current financial year. So in other words, the other 8 months times 8 divided by 12 is for the next financial year. So that means that we will now go to our general journal and we will say that we have made a prepayment on this expense. And therefore, we need to remove it from our Wi-Fi costs. So it might be telephone and internet, might be Wi-Fi. So let's go with telephone and internet. Right. So 6,480, 8 out of the 12 months was prepaid. So 4,320. So 4 out of the 12 months prepaid. I'm going to show that as a prepaid expense asset. And I'm going to say that I need to remove this from my telephone and internet account or then Wi-Fi account. We won't be too strict on that if we don't give you the specific account name.